apart from noting the trends in shifting towards flexible workspaces, Colliers has also released its 2017 fourth quarter figures, while on office, residential, hotel, and industrial spaces, mainly in Metro Manila. And to talk more about that, we have with us Richard Raymundo, Managing Director of Colliers International. Good morning, Richard, and welcome to the show again.
Hi.
Well, so let's get down to business.
Yes,
let's kick off with the businesses and kick off with business properties, that is office space. So, you know, last year there was this growing concern over the decline in BPOs dragging down tenancy rates. How did we fare ultimately in 2017?
Okay. So at the end of 2017, the vacancy rate for office in Metro Manila was around 5.3%. So that was a little bit higher than the 3.4% in 2016. Still very low. It's single-digit level. We had a very big supply and take-up last year. So last year, the take-up was around nearly 700,000 net take-up of office space. That is good news. And you saw that in the results of the property firms, Ayala, SM. You even saw that in Double Dragon this morning. So that's good news.
So this 5.3% vacancy rate, was that actually lower or higher than you had expected?
It was on track. We were surprised on the last quarter when it was really strong. You mentioned about Pogos, the gaming companies.
Yes.
BPOs used to take about 60–70% of take-up before. Now they're down to around 30%. And what has taken over that are the gaming. So that has taken up the slack. Which was left by
we actually
BPOs.
have that pie chart right there. If we could roll it for you, we have 35% Pogos now, you know, which is more or less the same as traditional companies, and BPOs now much lower at 25%. Very interesting development there. So do you think this will change after the PEZA has, you know, added more, PEZA building proclamations? Would this improve the BPO ratio?
That's good news, because we saw a lot of more PEZA proclamations in the fourth quarter. So I think there were 5 buildings that got proclaimed in the last quarter. So that's good. We are seeing more movement in the BPOs as well. That could go up a little bit this year from around 25. That could go up to 30–35%. But do not discount Pogos. That will still be strong. That will still be around 30% of the take-up this year.
And why the sudden surge last year in Pogos? Did you anticipate that?
It's just that a lot of companies are now looking at that space. It's profitable. It is legal, and then it is being done here in the Philippines. So there's the demand there.
Interesting. And in terms of traditional companies, are there specific sectors here at play maintaining this growth? I mean, still 35% is still a big
It's still big. It's still big. So what's interesting with the traditional companies these are companies that couldn't find space when the vacancy rates were at 1%, 2%, 3%. All of a sudden, you have a lot of good space that's open for them to consolidate, to expand. Coming from really old buildings, they're now going into newer buildings at very good rates.
And we still have, Metro Manila is still the main player here. But should we be looking at other alternative areas? Have you been seeing growth in any specific areas?
Well, Metro Manila itself has very interesting areas. It used to be Makati and Ortigas, then came Fort Bonifacio. Look at areas like the Bay Area. The Bay Area is very interesting. So you have a lot of space there. From SM, from ASEANA, you even have from Double Dragon, so that's doing very well. Look at Quezon City, that's another interesting play. Outside of Metro Manila, you look at Pampanga, that's interesting. You look at Cebu, you look at Davao. Those are getting good take-ups in office.
Very interesting there. Now let's move on to residential. So particularly condos, so these are the booming sectors as we know. 12.6% quarter-on-quarter vacancy rate. That looks worrying to me, but should we be worried?
That's a bit high, yes. So if you now compare that to office, that is not on a single-digit rate. It is high, but it is expected given that we had about 10,000 units which completed last year. We're expecting that to still edge up, given that we have 20,000 units completing this year. So that is a record high for residential new supply on an annual basis. But if you look at sales, it's still strong. If you look at the reports from Ayala Land, from SM, they were posting 15 to 20% increase in net income last year. That should continue this year. Take-up is still strong. And,
so no
prices are still going up.
No risk of oversupply and lowering of rental yields, let's say, because of too much supply.
Well, the rents have had some pressure. It's a bit difficult for rents to go up as faster than prices, but it should be in that range right now.
Okay, so still, regardless of this 12.6% figure, still an increase in rental
but very
rates.
minimal.
Very minimal.
Yeah.
Okay, gotcha. Now let's take a quick check on the hotel space. Yep. We had foreign arrivals at a record high last year that drives the hotel sector. But what's the new target market? I mean, how should hotels position themselves? Business hotels, 2 to 3 star. What areas of interest for hotels?
If you look at the numbers, we had about 6.6 million visitor arrivals last year. That was up by 11% year on year. The most interesting part there is China is now number 2 in terms of visitors coming into the Philippines. That used to be the spot for US. The number 2 spot, there was nearly 1 million Chinese visitors in the Philippines last year. That was up by 43% year on year. That's impressive.
There you go. So it's Chinese tourists driving it.
That answers your question. Another one you were asking on what type of hotel should people be or developers be looking at. I would say a good 3-4 star hotel, mass market. If you look at where the market is going, that should be that would hit the spot.
Very interesting insights there on, well, very positive outlook as well on the property sector in general. Thank you very much, Richard Raymundo, Managing Director of Colliers International.
Thank you.